right, we're back. And just before we get started, quickly reminder that you could always go back to my main blog site, Badcharts.com, and you could read a little bit about me. I wrote down a little one paragraph about since when I've been doing this, a little bit of my background, and you could start even like I like to call the Which Way book links, jumping you all over the place and trying to link it all together, right? There's information sometimes from one analysis which leads to another, and sometimes that concept seen in one while it's not seen in the other. You could go through all of that. See, that's an example where I describe my concept of walls. And after that, oh wait, I did a previous tutorial on it one time ago. And here's another different example with another instrument. And then you could go through all that. Loads and loads of fun. Okay, let's go back to the serious stuff, which today will be the NASDAQ comp index. Let me load that up right now. All right, there we go. We're live. Okay, so let me restart by removing all my trend lines. And what do we have here? All right, let's jumpstart all the way to the latest breakout. And it's right here. Here's my launching pattern. 1 year, a year and a half, almost 2 years. Long time. Measure and move, top to bottom, added to the breakout line, and close above breakout line is this candle right here. Would have put a sell stop right under the wick here, entry here, target here. The thing is, you have valid patterns, but sometimes the risk to reward is just not worth it. So you say, I'll pass, and this could be one of the case, right? Since that's your risk. If you had the risk, just for you help visualize, risk 1, reward 1, and 1.5. So that's kind of low. Might not be worth the entry, but if it's still a signal that the continuation is likely to happen, just maybe not traded according to your risk protocols. And you see all this? This is noise. All these candles, these wicks. The market still decided to close above that resistance line, and all this could have been intraday noise. Let's zoom in on the 5-year weekly, and these I would have considered maybe false breakouts if somebody would have played that on the weekly. Somebody could have said, I have a top formation here. But no, these are false. Was that a gap down? Let's go see on the month on the daily. All right, daily. I just have 1 year, so just have to back up. Moving. Hold on. See, 5 years, daily candles. All right, here it is. Zoom in a little bit by removing candles. And that's kind of messy. Move some more candles. Lots of candles on the daily. What happened here? Down, down, Yeah, it seems to be a gap down, right? Open here. Green candle means the bottom. The open was at the bottom and it closed here at the top. So there was actually a gap down. That explains that green candle. Oh, sorry. Let's go back on the 5-year weekly just to finish my erratic thought processing. And these are candles that I wouldn't have not even looked at or considered in my trading. Just noise. Sometimes it's a valid breakout on the weekly. Sometimes it whipsaws. I believe that there's more of these whipsaws than whipsawed singles, false singles. Let's call them false signals to enter a trade on the weekly, and even more on the daily. So I just wait for the price action to be all that my monthly candles to remove that if need be. And I'll see that as a wicks above and below the resistance and support lines that I would have drawn. And that's it. Let's go back to the monthly candles. And even here, like, you could kind of see the, depends how you draw your lines, where you put your sell stop, when you enter. But you could have been triggered out by these candles going back under the resistance line. If that's how you would have drawn your line, I don't know where you would have put your sell stop. Would you have put it under the that small weekly candle that crosses over the breakout line? You would have tested it once, and then 2-3 months later you would have tested it again, but this time maybe triggering you out. I just try to avoid altogether those situations. I did a lot of trading with hourly candles, daily candles. Look, I had some breakouts, some valid breakouts. I had some good winners, but I've also had a lot of trades, just a lot of losers. So my success ratio of reaching my target was a lot lower, maybe around 50% when I was on those smaller candles, even less, maybe 40%. But since I had a good risk to reward ratios on my winners, I ended up being net positive on the P&L. On the monthly, well, I take a lot less trades, and I reach my target way more often than I used to. Maybe 3 times out of 4 I reach my target. But I play a lot less. And look, it might be equal at the end of the day on your net increase in NAV year over year. But the way I do it is it permits me to do other stuff. I don't have to stay glued to my screen even if I love it. I have other passions in life, and I get to do other stuff that I like. And that's okay also, all right? You get to do what you want, and that's the most important thing, I think. All right, let's zoom back, finish with that philosophy. You got that breakout, 1 candle, 2, 3, 4, 5, 6 months later, and you're out. And that's what would have happened for me if I would have been playing the NASDAQ comp index at that stage. Let's see what happens now. Still going up. Look, there might be weekly intermediate patterns here, daily. Monthly candle could have had easily a bullish rectangle here, or pennant, whatever you want to call it. But on the monthly, there's just, you have to wait for it to be more solid than that. And goes up. What? That's it? Wow. Okay, so there's absolutely nothing to play here. Where's the support? Hard to tell, other than this resistance turn support right now, which I will do. I will put an alert here. Let's give you my margin. I'm trying to see here if I had some bearish divergence. No, price higher. There was some bearish divergence here with this one. peak to peak, then it went down, and there was some bearish divergence with here. So risk to reward, I went in, and I still had some bearish divergence. Price going a little higher, and the RSI refused to go higher. That's not A++ material. Maybe that would explain the little congestion here before taking off to reaching the target. All right, so let's see. Let's my imagination go a little wild. What are the possible moves? Eventually testing that support line here, and then maybe going back up to test this resistance, but I'm not even sure that's resistance yet. I would have liked to see a red candle here to see, okay, that's it. Markets decided that maybe that's a little bit of resistance. And the only thing I could do is put just an arbitrary target here. And if it's triggered, just come back to it and see how the chart is morphed. Let's go back to my website, morphing. Let's see if you'd search anywhere. Go down to the bottom, right here. Morph. Search my own little Google. And here, these are examples I did with about my concept of morphing. See, back in the days, I did that on April 8th, 2015. Wow, almost 3 years. And I did a little chart on a little example on the morphing. Here we had a pattern, bottom formation, launching pattern, right here for Exxon. Nice breakout candle. Nice target up here. See, back then, I know that right today I'm not thinking the same thing that I was thinking when I was 5 years ago. So I know the trading I'm doing now, my philosophy might not be the same, or it could be slightly different in the next 5 years. So I'm always open to that. And that's why we listen to other people. That's why we absorb information without going radical and changing everything you do. But it's good to know that there's other things out there. And I was less precise back in those days on looking at the launching pattern, on the shorter term pattern, giving me a closer target than these crazy ones that you get really greedy with these, right? It's a lot of reward for a lot less risk, and it's easier to jump the gun on that one. But I could have just seen here the smaller launching pattern, the 85 to 95 move, and play that, or just play this tighter range here. All right, moving on. What I did is I added here was a breakout here that we had. Then I added a year and a half of data. And oh, wait, what happened? A few more candles, and then you have that rising wedge that appears more clearly or morph into. And you even have a breakdown below the rising wedge. And you have a test of that support here. So you have a lot of things that happen with adding 5 to 10 candles. And that's like this scenario, bullish scenario, completely dead. And now we're looking at the falling wedge, the rising wedge, target back to $55. So I have no idea where Exxon is today. And well, let's just finish what we had before. We'll go back to Exxon right after. Let's go back, just tidy up on my comp. Set my alerts, maybe a little tighter. And I could even send I like setting a lot of alerts. They're free. This is zeros and bytes. And since I'm doing monthly candles, I put a lot of alerts. I like coming back to charts and see how they morphed. Because I have a lot less occasions to trade, and I want to maximize my chances by looking at the most amount of charts possible, to be able to get those A++ setups and not feel that I have to compromise because I have no selections at all. All right, so I don't know if you guys, if you're still in the comp or you're out. Right now I have no signals to go in or out, and that's what happens with monthly candles, or with there's a lot of a trend here. You see that all this, I I just couldn't be in it. It's okay. I don't mind. I don't see it as missed profits. I don't see it as anything. I just see it as a chart morphing to something different. All right, bear with me just a few seconds. I'm going to try to find Exxon. I didn't prepare that. I'm just going to pop it up and see what happened back in the days. Exxon. All right, here we go. Here's Exxon. 2015. What happened here? 2015. Was this where I drew my line? Yeah, I had the rising wedge, and then had the breakout here, which never happened. Okay. Or something close to that. Breakout here, that never happened, and then the price went, or maybe it was higher. Sorry about that. I just can't tell. Well, there was a morphing, right? You think there's a breakout here. No, price action reverts, never reached target. And new pattern here, rising wedge, and falling pattern here, top pattern. And now, but we never got back to the base of the falling wedge, the 55. That's what I wanted to get to. The only thing that happened was you reached the target of the closer intermediate pattern, that top formation. So the rising wedge never made it. These big patterns, man, with these far targets, really don't get greedy. You want this high to risk to reward ratios, but if you want a better probability of reaching your possible target, the shorter, closer term pattern is the way to go. It's a safer bet. You could always play that one, and then your target comes out, and then you could see if there's a consolidation pattern here that will help you go on and move on to your bigger targets. But that's all right. And that's what happened with Exxon. All right, I'm not going to go deep diving more in Exxon. I'll let you that. Today was supposed to be the comp index, and we did that. And maybe come more to Exxon and other charts examples that have morphed over the time. All right, thank you very much, and see you soon. Bye-bye.